Hello everyone, this is Scott Chan at Leeb.com, Leeb.com. Be sure to visit our website and sign up for our free market forecast newsletter. I want to talk a bit about the bank stress tests, which has been a buzzword lately. Treasury Secretary Geithner announced an initiative to try to weed out the good banks from the bad in February, but the tests have only been completed recently. The banks who were tested already know if they passed or failed, but the information hasn't been released publicly yet. Basically, if a bank fails the test, it means that the bank is insolvent as far as the government is concerned. It will need to raise new capital somehow. The government suggested a public-private partnership as a way to circumvent the very low balance of top funds and the need to ask Congress for more money. But the problem is, the stronger banks that investors would be more willing to put their money in don't need as much funding as the weaker ones do. And the weak banks that need the money the most, investors would probably avoid. I mean, wouldn't you? We're still in a vicious cycle. Banks are really caught between a rock and a hard place. On the one hand, the government expects them to lend out the top funds that they receive from the government, but on the other hand, the government also wants banks to have more capital on hand to cover potential losses. Banks, for the most part, have opted to sit on the money that they got from TARP. According to the Fed's weekly data, commercial banks now hold over $1 trillion in cash, which is more than 3 times greater than what they held last September. And of course, it's no surprise that certain banks, likely the ones who failed or tested poorly, are pleading to regulators to change their grades. As a result, the public release date of the stress test results have been pushed back several days to May 7th. In the meantime, stay away from banks. Have a nice weekend, everybody. Please join us again next week.